Welcome to Kitchen Table Finance, the podcast where we serve up bite-sized pieces of financial advice to simplify your money and your life. Join your hosts, David Shotwell and Nick Nauta, and let's get started.
Hey, Dave, how you doing today?
I'm doing great, Nick. How are you?
Fantastic. Beautiful day out there. Great topic on the agenda today. Who doesn't love talking about taxes this time of year, right?
Right. Yeah. Yeah. Well, it's still somewhat fresh. We're not too far removed from tax season itself. So,
Yeah. Well, to be honest with you, one of the things that people get wrong a lot, we're gonna talk about some of those tax mistakes and potential pitfalls. But the problem is, for most people, taxes happen in February, March, and April. Looking
when
back
it's
to
too
what
late.
happened last
Yes.
year, and really
Yeah.
what you should be doing right now, which is what we're starting to do with all of our clients, is running projections, seeing what's going to happen this year, seeing what things you can change or
So,
alter or do to improve your situation over the long term, because by the time you get to next year, and in March or April, it's too late for a lot of this stuff, right?
well, I think you just preemptively blew up our outline for today's topic, which is tax mistakes. And I think
Right.
and we did not have that on the list, but I think that might be the new number one right there, is
Yeah.
just not thinking about tax issues until tax filing time.
Right. Yeah. And there are some things that you can do after the end of the year, but the majority of them,
Right.
it's kind of too late. And so this is a great time to A, talk about it, and B, start thinking about it, running some
Right.
projections and
Right.
thinking about what you can do. So
Right.
I think the other problem is a lot of people, especially, pre-retirees getting into that retirement age, focus on returns and also, socking away as much money as they can, but they don't always think
Mhm.
about the tax efficiency of some of these decisions.
Right.
And so that can cause some problems as well. Like, we're so, we've just been kind of trained to just set money aside in this, pre-tax retirement account. It'll grow, you'll get to retirement, and then everything's honky-dory from that point on, right? But there's some nuances to that people need to think about. And so sometimes we get just stuck in that hamster wheel of, we're just going to do this thing, and then we're going to have all this money and retire, and everything's going to be rosy and sunny, right?
Right. Right. So, yeah, essentially all of these mistakes in one way or another fall into that category of not planning ahead, not
Yeah.
thinking ahead.
For
Yeah.
sure.
Number one on our list, is ignoring tax diversification.
Yeah. So, kind of like what I alluded to earlier, of we just get in this habit of putting money aside in our 401ks, 403bs, 457s, on a pre-tax basis, and
Right.
not really thinking about it. And that's a good thing, but it also causes some problems on the other end that you want to start thinking about. And so, I hate to throw this out here, but it is out in the media, so it gets sensationalized a lot of times into the tax time bomb, right? Like, they make
Yes.
it sound like this is the worst thing that could ever happen to you. The government's going to come in and take away all of your retirement money and taxes.
Right.
And that's not necessarily the case.
No.
And there is usually there's usually a window where you can kind of solve some of these problems after retirement. But the example there is, if you have all this money in pre-tax retirement accounts, and you are, taking distributions in retirement, when you hit age 73 to now potentially 75, depending on how old you are, you have to start taking required minimum distributions. And that causes you to lose control of how much money you can take out of those accounts. And sometimes you're forced into taking out much larger distributions than maybe you need, so that you can pay taxes on them. And
Yeah.
that problem kind of builds on itself, because that amount goes up, and can potentially push you into higher and higher tax brackets.
Yeah. So just like we want you to diversify the actual investments inside those accounts, we want to diversify the tax treatment.
Mm-hmm.
So essentially, we're talking about three different forms of savings There's pre-tax, which you've been talking about, traditional IRA, traditional 401k. There's tax-free, which is Roth. Shouldn't say tax-free, taxed up front, and then it grows tax-free,
Yeah.
but then gives you that flexibility in retirement to take distributions without incurring tax, and does not impact required minimum distributions. Then there are no required minimum distributions on Roth. And then the other one is after tax investing outside of retirement accounts.
Yep.
And there we're talking about just a good old fashioned brokerage account, usually made up of stocks and bonds, where when you take money out, you may pay a little bit of capital gains tax, and you're going to pay tax on the interest and dividends, but you can invest that tax efficiently while you're doing it to
Yeah.
minimize those things. And I'm going to put a little asterisk on there because we hear a lot of folks in the insurance industry pushing that money into insurance products like annuities and whole life because it grows tax free then. But all you're really doing is creating more pre-tax investment money
Yeah.
where eventually if you want access to that cash, you're going to pay tax on it.
Yeah, people oftentimes sleep on the brokerage account, and unfortunately, if you look at kind of how that money is taxed and when it's taxed, it can actually be pretty
Yeah.
efficient from that standpoint. There's long-term capital gains rates, qualified dividends get preferential tax treatment in a lot of cases.
Right.
So it ends up being not as bad as, like you said, some of the people
No.
in the insurance industry will make it out to be.
Right.
And a lot of flexibility with those accounts too, which people
Right.
love as far as
Right.
when you're taking out money and things like that.
Right.
So, but in the ideal world, you call me up because you're about to retire and you've got some money in tax deferred, you got some money in taxable, and you got some money in tax, already paid Roth, tax-free
Yes.
distribution Roth money. And we can that gives us as planners a lot of flexibility in terms of designing a retirement income plan, keeping taxes where we want them, and having that flexibility through your retirement years of,
Yes.
when to pay more taxes or take out more taxable money, take out less. Like we can kind of play that game when you have a good split between those three sources.
Well, and that's a good segue to our next segment, because if someone has been diligent about filling all of those buckets to a certain degree while they're working, then in the early years of retirement, we can look at Roth conversion opportunities. And our second mistake on our list was ignoring those opportunities to convert some of your pre-tax money to Roth money.
Yeah, I think it's one of those things that people get really worked up about, oh, I missed this opportunity, or I didn't, here's a great example. Michigan State University, they just rolled out the Roth 403b 457. So up until this point, you weren't eligible to make contributions to Roth. And if you made too much money, you couldn't make Roth IRA contributions. So you really haven't had a way to do that other than, we won't talk too much in detail of the old backdoor, Roth IRA. But for the most part, you didn't have those opportunities, right? And so if you find yourself in that situation where you've got a bunch of money in pre-tax retirement plans and haven't had the opportunity to put into Roth, or potentially taxable, like you have a lot of people from retirement to when they start taking required minimum distributions, and even in some cases afterwards, have this opportunity then to make those conversions, and kind of get some control over what those future distributions will be, in that kind of window. So there is potential for doing Roth conversions and getting some money into Roth after you retire, which I think is a good thing for people that haven't had that opportunity. There are obviously some things that you have to think about when making those decisions. It's not like you just one day wake up and decide you're going to convert everything all in 1 year. That's going to cause other potential problems. Like there's a lot of nuance that goes into that.
Yes.
We're not going to go into the details today, but we did a podcast episode on Roth conversions and kind of how to think through that. So I'll make sure we link that in the show notes. But I would just say that, it's not something that you want to ignore, you want to think about. And, you have a couple of those potential years that you can do this with. And this kind of goes into our next point too, Dave, which is um, poor withdrawal planning assumptions in terms of when you're taking money out of certain accounts, right?
Yeah.
And this example came up. I think it was last year where I got a call from someone that I worked with in the past and started doing stuff on their own and called me and said, we really need some help with some tax planning. We've been
Yeah.
retired for the last 2 years. We've just been pulling money out of savings. And I'm thinking to myself, you lost 2, 3, 4 years of potential really good
Opportunity.
opportunities to
Yeah.
convert,
Yeah.
because you took everything out of one income source and probably had really low
Right. You
income
paid almost
rates.
zero tax in those years, but
Yeah.
now you're going to pay higher taxes in the
Right.
future. You could have
Right.
averaged those out with a little planning.
Yeah, so that all kind of goes into this, discussion of figuring out what your withdrawal planning, like where should you withdraw from if you have all three of those sources. If you've got pre-tax IRA 403b type money, if you've got brokerage accounts, if you've got Roth IRAs, Roth 403b plan money, like how do you figure out which one of those sources to take out of? And we often see people default to the easiest in some cases, and or take everything.
Back to point number one, they're only looking at this particular year. How do I
Yeah.
minimize my tax? Oh, I can pay almost zero income tax if all that money comes out of savings. Well,
Hmm.
yes, you can, but you could have withdrew from your IRA up to the 12% tax bracket and potentially saved you from jumping into the 22 or 24% tax bracket at
Right.
some point in the future. That's the big thing, is to look at the average over your entire retirement, not just any particular year.
Yeah, absolutely. And just thinking about how not only where this money should come from, but and not and how long it will last, but also how's it going to be taxed and how can we maximize the efficiency
Yeah.
of when and at what rate it's taxed at. So our next kind of tax pitfall mistake, if you will, here is just underestimating or not really thinking about how required minimum distributions will impact your plan.
Yes.
If you and this is tricky because it it's not like it's a large, if you think of it in terms of percentages, it's maybe not, a large percentage to start, in terms of how much you have to take out. But also, if you're going to retire at, say you retire at 60 and you got a million and a half in a pre-tax account, by the time you're 73, that could have doubled depending on what kind of
Right.
distributions you're taking out of it,
Yeah.
right? And so the more it grows, the bigger those numbers are, the higher it potentially pushes your income up.
Yeah.
And so not paying attention to what those numbers will be or projecting those out
Yes.
is potentially can get you into some trouble.
Yes. And with all of these things, you've got to consider not just tax brackets, but also Medicare premium increases that are based on income and how
Hmm.
your Social Security is taxed.
Yeah. Yep. It all kind of plays together, right? So,
Right.
it's all kind of from, where you withdraw from to whether you're doing conversions to what's taxed, what's not taxed. It all kind of plays together in terms of developing this retirement income
Yeah.
strategy. um you know so there's some potential things to think about and making sure you understand and projecting out what those numbers will be so that you can make good decisions now, because those decisions that you make in early retirement or before retirement really will impact what happens in your future retirement years.
Yeah.
And right on cue, Dave, Social Security taxation is
You
also
think that
on
was an
there is
accident? Yeah. Segment number five, or
yeah.
point number five, Social Security taxation blind spots.
Yeah.
So you've got to understand how your overall income interacts with how your Social Security is taxed.
Right.
Um, and it seems like this, a lot of folks don't understand this, but it's basically like so many things with tax. You make one decision and it changes. It's like a moving target in some ways, and how it
Right.
affects other aspects of your taxes. So up to 85% of your Social Security can be taxed on the federal level, depending on your income. So as your income goes up, the amount of Social Security that's taxed also goes up. So it effectively is like your tax bracket is rising faster than what the actual marginal tax rates would make it look like.
Yeah.
Yeah.
And so just being aware of that dynamic and thinking that through in your planning of when or where you're going to take money from, how that's going to impact your Social Security, right? And so some of the give and take there is if we're lucky enough to have, Roth money, brokerage account money that's not really taxed when you take it out versus pre-tax,
Hmm.
there's this tendency to want to keep income as low as possible if you're taking Social Security so that you don't pay taxes on more Social Security. But what is the end result of that
Again,
when you hit
yes.
RMD age, right? So, like, putting those things next to each other and seeing them out and running different plan scenarios to kind of see what happens from a tax impact, right? Like, that might be
Hmm.
really good right now, but it might make things really bad later on. And how do those
Right.
things square away, and how do you feel about that? Um,
And also too, that if you back up to like the beginning of retirement, when you claim Social Security, there's a lot of
mm,
aspects to that, but one of those aspects is how does that impact your Roth conversion strategy and other things?
right. Yeah.
Because, in an ideal situation, you're not claiming Social Security until later, so that and that increases your ability, your flexibility to do more
Yeah.
conversions.
Absolutely. Um, the next point is overlooking capital gains planning. And this is another really tricky one. I mean, there's a couple different things here. One is depending on where your income is, you might be in a position to take capital gains at the 0% tax bracket on a federal level. So if you have that kind of sweet spot of income, you might be actually be able to sell something. Now, this we're talking about long-term capital gains here,
Hmm.
right?
Yep.
So long term is I bought something and held it for at least 12 months or longer,
Yeah.
versus short term is anything under 12. So short term is taxed at your ordinary income levels, where
Yeah.
long term gets the preferential long term capital gains. And for some folks, that might be zero.
Right.
The majority of people, it's usually 15, but we do have that kind of sweet spot, especially depending on how much income you have in retirement, where you
Yes.
might be able to take it at zero. And if there's anything that you can ever do and pay zero taxes on it from a tax standpoint, that's usually a
You
good thing,
absolutely
right?
should. Yeah, the default like standard advice is don't sell an investment that has capital gains until you have to, right?
Right. Hmm.
And if you leave it as an inheritance, under the current laws, your children will get a step up in basis and not pay any capital gains.
Yeah.
However, you don't want to miss those opportunities. And kind of circling back to where we started, those are decisions that you should look at in the fall.
Right.
Am I in a situation this year where I can pay zero capital gains tax, either because your income is going to be low enough? There is a cliff there where if your income is below a certain threshold, you're in a 0% capital gains tax situation.
Yeah.
By all means, as you said, always pay zero when you can. And that doesn't mean necessarily you're getting out of the market.
Right.
For in today's investment world, you can sell one investment, invest for capital gains harvesting reasons, and
Hmm.
invest that money in something similar that has the same investment potential, and you've taken advantage of essentially increasing the cost basis on that, so that
Right.
then your taxes in the future will be lower. It's just good planning.
People get confused a lot of times about, because if you are doing tax loss harvesting, which is another thing to look
Right.
at, right? There are some rules around. You can't sell something and buy it right back. You have to wait
Right.
the 31 days. You have to buy something,
Yeah.
different enough. But with gains, they don't really care. If you want to pay the taxes now, you want to take the gain, you can sell it and buy the same thing back, and nobody cares
Yeah,
on the
and you
upside.
caught me there, making the same mistake you're talking about, that that you've got to buy something different, just because that's usually the context we're
Yeah.
talking about this in.
Right.
But
Yep.
you're absolutely right. You can buy the same thing back if you're realizing capital gain, and the IRS is not going to care.
So one of the caveats to that is, if you pay 0% federal taxes, there is the potential for state taxes with that. So something that you have to be wary
Right.
of, right? You might end up picking up some state taxes. State of Michigan, obviously, at 4.25. So if you get zero federal, and you're basically, if your normal rate is 15 and you're getting zero, you're saving 15%. It's worth it to pay 4.25 of state
Right.
taxes in order to do that in most cases.
Right.
But something to just be aware of
Yeah, that's a
when it
good point.
comes to that. And then we talked about it a little bit, but the flip side is capital loss harvesting. And so that's another thing that you can look at depending on where you're at from an income standpoint. It might make sense to, if you have some losses in your portfolio, be able to take those to offset future gains or offset a
Right.
little bit of
Right.
income. Fortunately or not for us, especially lately, it seems like it's very challenging in this market the last couple of years to
Well,
find anything that has a loss.
yeah, it's a good problem to have.
Yeah, I'd much rather have that problem than the opposite of,
Sorry,
you
your
know,
portfolio went up and we can't
yeah,
harvest any losses, but
right,
eventually we'll get the opportunity.
right. What was that? The story that you tell about your coworker who had a bad investment in a client account, and
Oh yes. Well, the good news is you won't pay capital gains again for the rest of your life. It's really
yeah.
what it came down to. Yeah.
So yeah, I would much rather have the problem of not finding losses than harvesting enough losses to
Right.
never pay
Right.
capital gains again.
Right. That was the middle of the tech crash and
Yeah.
inappropriate investments to begin with.
Yeah, there you go. Another thing, we kind of alluded to this earlier,
Mhm.
but the Medicare IRMAA rules and making sure you're
Right.
paying attention to those. You want to go over what IRMAA is?
Well, IRMAA is the income derived component to the Medicare Part B premiums that you pay. Essentially, they work as cliffs in addition to your marginal tax rate going up at certain points. And I won't go into the exact details, but at certain points, then your Medicare Part B premiums will jump as well based on income.
Yeah,
And so you need to be aware of that. Plus, you need to think about it across multiple years too.
right. That's another tricky one where in some cases it's actually worth it to,
Right.
do a conversion and pay a little bit extra. We're not talking about tons of dollars, and if it ends up,
Yeah.
if you save a bunch of money in the future taxes, sometimes it's better to pay a little bit higher premium on that, but it's certainly something that you want to be aware of, right?
We've touched on this in a separate podcast, but it has a psychological component to it that I think is tougher for people to stomach than just like telling them that instead of being in the 22% tax bracket, it's like you're in the 23. I forget exactly what it works out to, but it's like you're paying a slightly higher tax rate. That usually doesn't change people's thinking.
Yeah,
But when you tell them, oh, but next year they're going to subtract more from your Social Security benefit to cover your
right.
Medicare Part B premium, that hits home a lot harder.
Yeah,
So you need to be, but like so much in finance, you need to be careful of falling victim to behavioral, psychological impacts
yeah,
that aren't, what's the right word? Are that letting those drive the bus instead of the actual financial outcome.
yeah. That's a great point, and I think it's a hard concept of, nobody thinks about and goes into a year and says, "Man, I want to pay more taxes this year," right?
Right. Right.
Like the
Right.
default is pay as little taxes as possible
Right.
as you can.
Right.
But the reality is, and when you're doing tax planning, when you're thinking about these things, a lot of times it makes sense to pay a little bit more tax now in this year at a lower rate to avoid paying more taxes in a
Right.
future year. But it's kind of
Right.
counterintuitive to what we've always thought of when it comes to taxes, right?
Yeah.
Another thing along those lines that I don't think we had on our list, Dave, is premium tax credits, right? And so if
Hmm.
you are getting marketplace insurance and you're retired and you qualify for a premium tax credit, which they
Yes.
do still exist, depending on the income level that you have. And I've seen this happen before where somebody's advisor told them, hey, you should really do a Roth conversion, had no idea that
Mhm.
they were getting a premium tax credit. They did their taxes, and all of a sudden they owed a couple $1,000s back to the government for
Yeah.
their insurance because they didn't qualify for that premium tax credit any longer and had to
Yes.
repay that because of the extra income from the
Yes.
conversion. So that's another thing that if you're using the marketplace and you're getting a premium tax credit, you have to be aware of if you're retiring
Right.
before 65 and using the marketplace.
Right. Particularly, we'll toot our own horn here for a second. If you're working with a non-holistic financial planner who's just focused on your investments, they may recommend
Mhm.
a Roth conversion with no idea what you're doing for health insurance.
Right. Yeah,
Yeah. Yeah.
absolutely. So, it all, like I said, it all kind of coordinates together. And so having, someone that's looking at all of those pieces and parts is super important when you're talking about taxes and retirement. And
Yeah.
specifically for us, we work the best when we can coordinate with someone's CPA or tax preparer and make these decisions kind of together, and think them through. I think that really helps a lot of folks as opposed to just having one source for that, or not
Mhm.
pieces not talking to the other part, right? If your tax preparer isn't talking to your planner, doesn't know what's going on with your insurance, like there's a lot of potential disasters that we see there when it comes to that. Really, we shouldn't have done that kind of thing,
Right.
right? Because
Right.
a lot of these things, if you do them, like a Roth conversion, you can't change your mind. Once it's done, it's done.
Right. Right. Point number 8 here on our list. Michigan taxes. We should probably say state taxes in general. We do have out of state clients
Sure.
listening. But state taxes sometimes become kind of an afterthought in tax
Yep.
planning,
Hmm.
and because they're lower and less impactful and usually somewhat less nuanced than federal taxes, but they still are an important factor to consider
Yeah.
when you're
Hmm.
pushing and pulling these different levers.
Yeah, I think specifically in the state of Michigan, there's been a lot of talk about the changes of
Mhm.
Social Security not being taxed, getting preferential treatment now on retirement income.
Pensions and
There's some
IRAs. Yeah.
changes to that, some caveats as far as how much you get, what ages. Like, that's all stuff that you need to know when you're pulling these levers and making these decisions as a part of your overall plan.
Right.
And because of those changes, not everybody's aware of it. And so, like you
Yeah.
said, 4.25 usually for the state of Michigan at least doesn't change a lot of those decisions, but on occasion, it is something that
Mhm.
you want to look at and be aware of.
One thing I'll say about the state of Michigan too is when you get your withholding wrong on the state of Michigan, like if you do a Roth conversion and you don't pay
Mm.
estimated tax,
Hmm.
a lot of times with, I probably shouldn't say this, but a lot of times with the federal taxes, there's more leeway
Sure.
about whether you withheld enough. The state of Michigan, even though it's a smaller dollar amount, they will impose penalties
Yeah.
and interest. So,
They're one of the harshest when it comes to underpayment penalties. So another
yeah,
thing to be aware of. I think that's a great point too that we should have had on our list. Not paying attention to your tax
withholding.
withholding, like when you're
Yeah.
doing these things, how much taxes should you have withheld, depending on where your distributions are. Like nobody wants to. Well, there's two sides to that, right? Nobody wants to be staring in a $10,000 tax bill in the face without like
Mhm.
knowing about it or why, and the potential penalties that come with it. And the flip side of
Right.
that is you really don't want to be getting a
A
fifteen
big
thousand dollar
refund
return
either,
either.
right, yeah. The way I put it to clients is usually my personal ideal is I'm writing a relatively small check to the
Yeah.
government in
Right.
April. Not
Yeah.
getting money back, but writing a small check, a reasonable
Hmm.
check.
Yeah, for sure.
Yeah.
Kind of our last point here, and we've talked about this a couple times already today, but just not having a tax aware plan.
Yeah.
The problem kind of stems from if you're doing your tax planning for 2026 in March of 2027, it's too late, right? You
Yes.
need to be forward looking about what the potential is,
Yeah.
and also and just thinking through those situations. One of the other things too, and the reason why we kind of structure things the way we do around here is, like I said, a lot of those decisions that you make are irreversible. And so, our fear is always we do a Roth conversion in January. You decide you have this amazing opportunity to take a trip around the world, and you need to take a big chunk out of your IRA, and all of a sudden all that math and
All
all
the
that
tax
work
planning's
goes out
changed.
the window.
Yeah.
And so it's much easier for us in December to make those decisions. We have the
Yes.
majority of the information. It's not likely that it's going to change in 4 weeks. And if it needs to change, a lot of times we can defer some of those distributions or other things into
Into
next year.
January. Right.
So just making sure you have a plan that's working together and you understand the ramifications of those decisions.
Bigger picture, like we do with so much in financial planning, I like to think about it in terms of strategy and tactics.
Mm-hmm.
And so it's pretty common for us. We've got, all the tools that will let us look out over, your entire retirement and get an idea of, okay, in the first 5 years, we want to fill these particular tax brackets with Roth conversions. Here's where your income should come from. Blah 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 blah. Right, and we can develop this strategy, but on a year-to-year basis, it's still about tactics. It's still
Right.
about saying, okay, that might have been our strategy, but let's look at where you are here in November of 2026 to
Mm-hmm.
determine how close to our strategy are we,
Yeah.
and what do we actually do.
Right.
So you got to kind of think big picture, long term, rough outline, have a general idea of what makes sense so you know what to look for in any given year and what
Sure.
might work for your plan, but then validate it in the year that you're doing it as though it's a fresh, discrete year.
Yeah, absolutely.
Yeah.
And I think one last thing too, Dave, kind of in closing here, all of these are great strategies. All of these are things that you should be looking at and doing. But what you don't want to do is make it the major primary
Right.
focus, right? Like if the goal is to enjoy life now, especially in retirement, what you don't want to do is pay a bunch more taxes now so that when you're 85 and not doing anything, you have a lower tax bill, right? Like that's not the goal for most people. And so thinking about how that impacts decision making is important.
I would take that a step further too and say, and I got this cliche from another advisor who was a mentor of mine 20 some years ago. Don't let the tax tail wag the financial planning dog,
Yeah.
because because so much of this is a little bit subjective and about your goals and what, like don't defer that trip to Europe so that you can do a Roth conversion,
Right. Yeah.
right? Or I wouldn't do that. I mean, maybe if tax planning is your jam more than
Right.
more than going,
Yeah.
somewhere fun, but don't let the tax dog or tail
Yeah.
wag the financial planning dog.
Right. Yeah.
Think about your goals and what your overall values are before you decide the tax strategies.
Yeah,
That
I
comes
think that's
secondary.
a big part of this that gets missed sometimes around like what's your end goal, what's most important to you, and that sometimes can define or drive some of the decision making when it comes to some of this tax planning, tax type stuff. So just be aware of the first thing you want to do is achieve your goals and live the life that's most important to you, and then from there we can figure out how to do that in the best way possible from a tax standpoint. But we don't want to put the taxes above your quality of life, right? Especially in your retirement years. So with that, Mr. Shotwell, as
Hey,
always, it's been a pleasure, my friend.
thank you, sir.
Thank you for joining us for another chat about your retirement and finances. Please hit that subscribe button. You can also contact us at srbadvisors.com or email us at info@srbadvisors.com. See you next time on Kitchen Table Finance.